Hi, greetings, it's me, Dr. Paul Gerhardt, and this is video number 6 in our entrepreneurial series. And this is probably the most technical out of all videos and probably the most boring, but it really is the one that if you are an entrepreneur or considering being an entrepreneur, that you really need to understand. So you might want to watch this video more than once. It really has to do with whether or not a business is truly viable or not. It's about analyzing cash flow and other financial information. Let's face it, if you start a business, you got to be able to turn a profit, or it's really not worth it unless you're just like having 2 jobs and throwing lots of money away. And yes, lots of people who start their own businesses currently have a job, and then they get this other thing going until it starts turning a profit. And so we want to talk about some of the main terms and some ideas related to cash flow and other financial information. So in this video, we're going to talk about looking at cash flow and cash flow statements. And yes, I'm going to have to read some information to you just to make sure that I get the terms correct, because we don't generally talk in these terms all the time because we're really thinking about major money operations. But if you really understand the terms and the concepts related to it, you can put the right systems in place to help make sure that your business is healthy. And we analyze an organization's success by looking at financial statements. And so in this video, we're going to talk about cash flow versus budgets. And we're going to look at how what kind of tools are available, like balance sheets, income statements, and doing a break-even analysis. So it's a very fundamental financial overview that if you really understand these concepts, you truly can measure the health on how well you're doing and then create a strategic plan for your business. So let's talk about cash flow. Cash flow is the actual cash that flows into a firm minus the cash that goes out of the firm. So simple enough. You got revenues coming in and you got expenses going out, essentially, right? So cash flow is not the same as profit. Carrying inventory results in cash flowing out long before any cash that from a product flows in. And so you can have negative cash flow. And cash crunch worsens when sales grow. You must forecast your real cash flow to prevent crush. So, the importance of cash flow analysis. The cash flow statement during this stage of the new venture differs from one generated by an established ongoing firm. For proposed business, the focus is on its ability to generate positive cash flow in the shortest time possible. Again, cash flow, not profitability. Profit is desirable, but cash pays the bills. Let's face it. You got to make sure that you're getting the bills paid, or you're going to have to close your doors. So, a term that we often use in business is float. That's the difference between when the money goes out and when it comes in. For example, if you deposit a check today in payment for some good, you typically do not receive cash when you deposit it. Instead, there's a period of float before it is credited to your account. So, cash flow versus budgets. Budgets, this is a statement that projects the costs that will be incurred by the organization over a period of time and allocates those expenses evenly over the relevant time period. Don't confuse cash flow statement with a budget. A cash flow statement does the exact opposite of a budget. Budgets are helpful, but knowing the amount of the cash you need to pay bills, that's the reality. So, for instance, if you are running a startup software firm and you get a total receipts for $6,000 in January, but your total disbursements, your payments for $8,600 in January, and then you've got an income investment of $10,000, you have a negative net profit of $2,000 $621 and an ending balance of $7,378. But in February you get a total receipts revenues for $7,500, but you're paying out $8,171 in disbursements. And you have a beginning balance of $7,379. You have a net profit of negative $671, or an ending balance of $6,708. As things go on in June, if you have total receipts of $20,000, you're building your business, and total disbursements of $9,671, you have a beginning balance of $19,196. You have a net profit of $9,196 and an ending balance of $28,392. So you can kind of see, if you're following me, how if you are continuing to increase your revenues but your expenses stay relatively sane, you start making money in the longer run. And so that's what you really need to look at when you're doing your budget is, can you guesstimate what your revenues are going to be, and then what your expenses are. And so that's why it's important to make sure that you have an equity investment to help you meet your expenses. So over time, once you develop systems and you continue to have happy customers and you've got the right expenditures through your business because you're doing effective marketing, you're keeping your customers satisfied, and you're not losing customers, but you're increasing your revenues, that's when the profit is going to continue to increase. So you have to really be able to project, where you're going to be and when you're going to make a profit and sustain that profit. So let's talk about a term called deviation analysis. Deviation analysis is an analysis of the differences between the predicted and the actual performance. This will help an entrepreneur in developing realistic forecasts and point out differences between actual and predicted performance at any point in time. And this really allows for you as an entrepreneur to maximize flexibility during your growth period. So, for instance, if you have total receipts predicted in January for $6,000 in sales, but you actually only have $3,350 in sales, the difference is negative $2,650. If you, for that same time period, you predict that you are going to have $8,400 in expenses, and you actually have $9,993. You'll get $693 in the difference. So net cash flow, if you have an equity investment of $10,000, would be in January predicted $2,400, but the actual January would be negative $5,743, or a total difference in your analysis of $3,343. So that's kind of how it works, and you just got to take a look at this concept a little bit more. But you got to do a prediction and be able to take a look at how well you are in predicting trends. When you're developing cash flow statements and budgets, there really are several key issues that you should note. One, a cash flow statement for a new business is much different from one generated by a public company. The cash flow statement shows the flow of cash during a specific period of time. A history of cash flow statements really helps you as an entrepreneur in obtaining loans and credit lines. It gives you an infusion of equity capital and a valuation if you choose to sell the company. So, beginning with expenses, you need to look at things like salaries, basic benefits, taxes and fees, payroll, local income state taxes, business licenses, the cost of your goods sold, manufacturing, packaging, direct labor, shipping, utilities and security, tools and machinery. Again, I would highly recommend that you hire a CPA. I mean, it's worth the investment as you get going so that you know what you don't know, because you'll have office supplies, travel expenses, insurance, advertising, furniture, computer, telephone, maintenance equipment, cleaning, rent, mortgage payments. So a CPA really can help you know what you don't know. And so this is kind of an overview for you to really be thinking about the finance. Let's talk about revenues, one of the most important things in business. For maximum insight, you have to divide things into categories. Like if you're a lawn care service, for instance, and you found that you make more money planting flowers and landscaping in your business, you might get these jobs because you create these lawn mowing contracts. And then if you want to really develop your business, your lawn mowing price is low in order for you to obtain the business to get a contract for landscaping. This can help lead to more money due to increased planting and landscaping for those new contracts. So you can kind of see how in your business strategy you can enhance your revenues, your cash inflows, by really being very clear in what your business looks like. Let's talk about a restaurant. People come to restaurants to eat, and but that's most likely not going to be the only thing that they get. If they come there, there's going to be other expenses that they are going to make some purchases beyond just the food. They're going to be having drinks, soda and then alcohol, and then maybe they're going to buy a pie or a t-shirt or something else that you have in your restaurant. So if you really have a good marketing plan in place and you're very, very clear on what your strategy is, in January you might have sales of $1,300, and then people buying drinks for $350, and then alcohol $450, and then miscellaneous, the pies and the t-shirts and things. You could have a total January revenue of $2,210. And in February, because they're happy, they're telling a few of their friends, you're happy customers, your revenues increase in February from $1,300 to $1,800. Your drinks go up to $490, and then the alcohol expense goes up to $770. You can make some good drinks there, and then your miscellaneous expenses go up to $200. Your total receipts would be $3,260. Let's go all the way into April. You guys are just doing a great job that you're selling you almost double, maybe $2,400 in April in food, where it was $1,300. Your drinks are consistent with that, where you've gone from $350 in January to $605 in April, and then alcohol is almost doubled from $450 to $810, and then miscellaneous $399. You really have your employees doing a good job of upselling, and you're keeping your customers happy, and they're telling their friends. I mean, that really is the key to any good business, is satisfied customers create more satisfied customers. So in April, you've gone from $2,210 at the start of the year in receipts to $4,210. So by April, you have had $13,569 in revenue that you've brought in, and it allows you to take a look at the relationships between food, drink, and alcohol and miscellaneous. So be able to take a look at what your strategy is. You can do the same thing in a clothing store. You consistently need to take a look at where things are. Maybe sales are going down in one category. Maybe you have a men's department and a children's department, and then shoes perhaps and accessories. And so being able to take a look at possible trends that are occurring in revenues. Maybe January is a better month for men's, but women's March is a better month. And so being able, maybe you're selling more shoes in April than you did in January. And so being able to look at total receipts and will kind of help you be able to create a better business strategy that allows you to take a look at trends and being able to see areas that you can increase your business. Let's talk about sensitivity analysis. This is an examination of best and worst case cash scenarios. So when we're talking about financial tools, we need to talk about pro forma. That's a term describing estimates of what the balance sheets and income statements will look like in the future. So far the focus has been on cash flow. Other tools are also helpful, and a new business will likely create pro forma statements, and this is a Latin term that means a matter of form. So you got to be able to do a balance sheet analysis, and a balance sheet is simply a summary of assets and liabilities for your business. You have current assets, and assets are things like cash and the other assets that can easily be converted into cash, such as accounts receivable and notes receivable. And then you have fixed assets, that these are things like a physical building, land, office equipment, machinery, and any vehicles. So your balance sheet liabilities, you have current liabilities and long-term liabilities. And current liabilities or debts that you as a business owner have to pay within 1 year. And these include accounts payable, notes payable, such as bank notes and accrued payroll. And then you have long-term liabilities, and these liabilities that are owed by the business and are ultimately due more than a year from the current date. These include mortgages, payable owner's equity, and stockholders' equity, and the latter two are the investments by the individuals in the business. So, balance sheet. The assets minus the liabilities in a balance sheet should total 0. And I'll say that again. Assets minus liabilities in a balance sheet should total 0. Thus, the assets and liabilities balance each other out. A balance sheet is a snapshot of a business at one point in time. The current assets minus the current liabilities are referred to as working capital, if that makes sense. So, a pro forma balance sheet takes a look at the relationship between assets, liabilities, and of course owner's equity. So your current assets could be $50,000, your fixed assets could be $340,000, which gives you $390,000 in total assets. Your liabilities could be current liabilities, long-term liabilities, and owner's equity, which would also equal $390,000. So you need to be able to use these tools to help you predict performance. Correctly predicting a business's performance can help secure better terms for business vendors and suppliers. You need to make sure you have good relationships, and you need to give them something to hang their hat on. So using an income statement, this is which will allow you to take a look at the revenue of your firm minus your expenses, and you have a focus on profit, and it is key in predicting sales. Another key is to really be conservative. You want to make sure that you're preparing yourself for best and worst times. So an income statement helps you provide both gross and net profit. And gross profit equals sales minus cost of goods sold. So gross profit equals sales minus cost of goods sold, and gross profit minus all expenses equals your net profit before taxes. Subtract estimated taxes for a net profit after taxes. Your break-even analysis is a tool for the estimation of when a business's income exceeds its expenses. And you have fixed costs, the costs that must be paid no matter how many goods are sold, such as rent, the building, for example, and then variable costs. And these costs vary according to how many goods are produced. So you have to do what's called a break-even analysis, and in doing that, you're looking at the intersection of total revenue and variable costs. You'll always have fixed costs, and so your break-even is, essentially that of how many sales and the number of units sold crosses total revenue and variable costs. So you got to know where your expenses are, your costs, and how much revenue you need to make in order to surpass those costs. So in business, you really have to take a look at something called the time value of money. And so you're looking at actual net cash flow, your break-even point, your actual investment, and being able to predict, how much time it's going to take you to make sure that as an entrepreneur you break even at least, and then you can go beyond that, and things are hopefully a little more easy street because you get your systems in place, right? So an entrepreneurial break even is when a new venture's net cash flows exceeds the initial investment plus the time value of the money invested. Let's talk about time value of money. The value of money over time at a given rate of inflation or other type of return. And this is calculated as the value of your investment in time and money if you did not do the proposed ventures. So you have to really think about where your money goes and how you spend your money and what you would have gotten out of that. So anyway, I've covered a lot of information on analyzing cash flow and other financial information. I highly recommend that if you haven't taken an accounting class or you haven't taken one in a long time, if you're going to start a business, familiarize yourself with the best business practices as it relates to accounting. It's all about the proper expenses. It truly could be worth it if you find a good CPA to help you set up the books and maintain your profitability. That CPA can make suggestions to you to help you really think about how you go about running a successful business. Anyway, I hope you've taken something out of this video. Again, this is probably the most technical of all the videos that I have because I'm introducing a lot of new terms, and it has to do with something that you probably don't think about all the time, but it really is about measuring the health of your business and gives you some things to think about as you create your business strategy within your business plan. All right, hope you've enjoyed the video. And more importantly, I hope that you enjoy your day, because only you get to choose how you feel about it. I'm Dr. Paul Gerhardt.